Hi, Justin.
Hi, Richard. How are you doing?
Yeah, not bad.
Good, good. We're just waiting for a couple more people to sign on, and then we'll get started.
Okay, and I just need to remind myself how
you share your screen. Yeah, I will stop sharing mine, and then you can.
Shall I do that? Shall I do that now?
Yep. One sec.
You cannot.
Okay.
That working?
That's working. Yeah, nicely done.
I'll just check that it goes up and down as well. 1 second. This is a complication on 2 screens, but it's not. I'm going to duplicate my screens if I can.
Well, I will say while you're figuring that out, to those of you on the call, thank you very much for joining. If anyone needs a hard copy of the presentation, it will be shared on here as we go. But if anyone needs slides during the event, please drop me an email on j.bell@numis.com. Likewise, if anyone has questions, which hopefully lots of you do, I'm sure Richard will be very happy to take questions as we go. If not, we will do some at the end. So there's Q&A function through Zoom, which hopefully some of you have used before and are happy with. If not, then again, just drop me an email or a Bloomberg message if you're on Bloomberg, and I will collate them and ask them as they come through. So, Richard, are you happy with the setup now?
I think I'm happy. We'll see how we go. If the slides roll through at my instruction, then all well and good. If not, we'll have a pause and get it working.
You're becoming a professional video conferencer. Well, I'll hand over, and thank you everyone for joining us.
Good afternoon, all. Here we are on the brink of lockdown easing, but obviously what I'll be talking about over the next few minutes is the impact of the lockdown that we've experienced so far on commercial property and specifically on Custodian REIT. I think this first slide tries to demonstrate in pictorial form the market has been sideswiped by COVID-19. And perhaps no surprises. But happily, Custodian REIT arrived at the start of lockdown in strong financial health. Let's see if I can get these slides to move now. There we go. I hope that's operational. We announced our net asset value as at the 31st of March, which just picked up the start of the impact of COVID-19 on property valuations. Because let's just go back pre-lockdown, we all started 2020 in the property market, and I think actually more broadly across the economy, optimistic for a return to a market where decisions could be made, lest we forget 2019 totally dominated by Brexit. And while it has made it back onto the news recently, we really haven't heard much about it in the last 2.5 months. But at the start of the year, with Brexit largely off the immediate agenda, people were very positive about the prospects of commercial property. and the market started very strongly. But COVID started to have an impact, and we certainly felt that impact on valuations as at the 31st of March. So NAV was down 2.8%, and that gave a NAV total return for the year to March of a perhaps disappointing 1.1%, but still positive. And if you break that down, that was about 6.1. If you'll excuse the rounding, you'll see this doesn't quite add up. About 6.1% of income return, and about 5.5 to 5.1 of capital value decline. But still showing how income is the principal driver of return, and how defensive it can be in periods of time when the market is moving against us. We approached lockdown with 25 million of cash on the balance sheet and headroom on gearing, and were able to close out our final dividend for the year to March, paying that in full, as at based on the target dividend of 6.65 pence per share, and that was a fully covered dividend. Of course, we have entered a new reality in the last 2.5 months, and property management is less about property management and more about rent collection. Rent collection used to be an almost automated function of managing the Custodian REIT portfolio. We collect the rent ourselves, and we had good relationships with all our tenants, and very, very few late payers, limited arrears. But in common with the whole market, the focus more recently has been on rent collection. And we reported at our last NAV statement that for the month of April, we collected 74% of the rent. And we look at this on a month-by-month basis, because some of our tenants pay monthly, some pay quarterly, some pay on Scottish quarters. And since we have started this process of rent collection, some now pay monthly in arrears rather than monthly in advance, and some have deferred the rent for the March quarter, and that's a contractual deferral. So a typical example would be, we say to the tenant, excuse me, you can defer the rent for this quarter, but we would like you to make up that rent in full over the next 12 months, or maybe even as long as over the next 18 months, just to ease cash flow. Importantly, as at today, we have conceded no rent. It's only been deferred, collected, or in some cases still being argued about, and that's about 8 to 10% of the rent roll. We are still having debates, and it won't surprise you to know that's broadly all in the retail and leisure sectors. More on that later. We took the step of underwriting our next 2 quarters dividends at 0.75 pence per share. And it's a funny old way in which the world works. We thought we were making a strongly positive statement, underwriting income, acknowledging that it's so important to our shareholders. And the press reported that Custodian REIT had slashed its dividend. Of course, we haven't slashed the dividend. We have effectively said, even if we collect no rent, and that's not a forecast, we do expect to collect rent over the next 2 quarters, that we will pay the dividend out of previous year's undistributed reserves at a rate of 0.75 pence per share. Now, if we collect more rent than pessimistic forecasts might suggest, then that could be higher. And again, that's not a forecast, but it's something that could happen. And as we go through the course of the year and we start to collect the deferred rent, so we will have the ability to pay higher dividends, such that we might be able to get back to what is more typical of our target dividends later in the year. As I've said, the dividend for the year to March was fully covered, as all our previous dividends had been. The year to March 21 might look somewhat different, and we are forecasting that we may not cover the first 2 quarters dividends on a quarter-by-quarter basis out of income, but it is our expectation that dividends will be covered out of income when we look at a full year. But of course, that does require some forecasting, and it requires a degree of optimism. And I do have a degree of optimism for the future. Debt, we went into the lockdown with LTV of 22%. We have a target of 25, so slightly below target, and a banking covenant at 35%. So plenty of headroom on our gearing, and importantly, no short-term refinancing risk. You know, the average unexpired term of our debt is 7 years. But acknowledging that we might face a more challenging quarter in June for rent collection, we have put in place with all our lenders preemptive interest covenant waivers. And this is to reflect the fact that all of our loans have an interest covenant at 250% cover. So rent collected, actual cash received, needs to be 250% of our interest for the quarter. Because we felt that there was a risk that we may breach that covenant, we have, and with the full consent of the banks, put waivers in place for the next 6 months. And that's important because it allows us to manage the portfolio for the best medium to long-term outcome for our tenants. If we were fearful of the bank pulling us up on a breach of interest covenant, we wouldn't be able to offer the sort of support we've offered to our tenants in deferring rent. And while it might seem big and clever to chase tenants down and be aggressive, actually the tenant-landlord relationship is a relationship, and it's one that we think is worth preserving, because we want the tenants to be there, not just this quarter, but next year, the year after, and many years into the future. So working with our tenants to support them is really important. And having that waiver in place allows us to manage the portfolio in the best interests of the long-term future of the portfolio, rather than in the best interests of short-term rent collection to meet a particular covenant. So what's the impact been on share price? And I'm sure it won't have been lost on any of you, the fairly dramatic impact that has been felt across the entire property sector. And what you can see here is a number of our close peers and their recent share price volatility. And what's interesting to note is that, by and large, the generalist investors, of which Custodian is clearly one, have had a more torrid time through the last 2.5 months than some of the specialist investors. Now, particularly people will be thinking about beds, sheds and meds. It's a hackneyed old phrase now we've got rather used to. And I think particularly I would focus on sheds. The meds rather speak for themselves, and beds I think perhaps have got other challenges. But if you look at the industrial portfolios, the industrial and logistics sector has proved to be more resilient. And the industrial specialists have seen less volatility than the generalists. But it begs the question, how has Custodian managed to perform more akin to the industrial specialists than to the other generalists? And I think a lot of that comes down to our specific strategy. So let's just take a few moments to remind ourselves what the Custodian REIT strategy is. So here is Harry Markowitz. We probably remember studying him at some point in our academic careers. And modern portfolio theory is what gave him fame. And what he is saying is that the total risk of a portfolio can be reduced by diversification. And it can be achieved by investing in assets with either a low or better still a negative correlation. I'm not teaching you anything you don't already know. A negative correlation when all our assets in real estate is probably unrealistic, but a low positive correlation is certainly achievable. And we set out our stall early on to be a generous portfolio, to follow Uncle Harry's advice and have that diversified portfolio. And it's certainly been the case over the last 18 months. As retail values have fallen, so industrial values have risen, and we've had the benefit of that diversification. And we mustn't lose sight of the fact that industrial and logistics property will not always be the answer. And there will come a time when other asset classes move in different directions. And we want to set this portfolio up for the long term. So we believe that a diversified portfolio does still make sense. And we managed to perform as well as the specialists without putting all our eggs in one basket. If you were to summarize the Custodian REIT strategy in 2 words, it would be diversified income. And I talk about both a lot, and I make no apologies for being boring on either subject. So I'm sorry if you've heard it all before. But income, that's what we're focused on. That's why rent collection has been so important, and working with our tenants to guarantee the medium-term recovery of that income has been absolutely key. We focus on properties of less than 10 million in lot size, and a little bit more on that in a moment. And whichever way you cut this portfolio, you will find diversification, whether it's by location, by sector, by tenant, by unexpired lease term. And perhaps it's most clearly demonstrated in the chart on the right-hand side, which shows the split of income by tenant across the whole portfolio, with our largest tenant, Menzies Distribution, representing 3.9% of the total rent roll. But if you were to dig further, you would find geographic diversification. We've got properties in England and Scotland and Wales. And you would find further diversification because there are 8 properties that make up the Menzies Distribution portfolio, a portfolio that we acquired in the autumn of last year. And it's fundamentally urban logistics assets. Menzies Distribution distribute print media, and they acknowledge, as we do, that that is perhaps on the wane, but they also have a root and branch distribution network and existing delivery routes to every supermarket and newsagent in the country. And they have been successful already in picking up other logistics contracts that are complementary to their existing business. And we saw that opportunity and took advantage of that. But they're our largest tenant. B&Q, our next largest tenant. B&Q have continued to trade through lockdown. They had a good start to the year pre-lockdown. And again, we've got 3 properties in that portfolio, 1 in Scotland, 1 on the south coast, and 1 in the home counties. So again, further diversification, even more than you can see shown on that chart. One of the things that Harry Markowitz didn't talk about was residual values. What do I mean by residual value? I mean the vacant possession value of the property, what the property is worth when the tenant is upped and gone, and we've just got an empty vacant asset. And it's not something that I'm particularly aware that other fund managers focus on. We do, to the extent that we ask our valuers to provide us with a residual value, vacant possession value, for every property in the fund. And across the fund, the value is best guess, and it's a slightly difficult question for them to answer because there isn't a developed market for vacant properties across all sectors. It's by and large an investment market, but using their skill and expertise, their best guess of the vacant possession value of our portfolio is 72% of the investment value. And that gives me great comfort that we've got underlying value. We want buildings that are fit for purpose or modern, and again, a little bit more on that in a moment, and we have a gearing target, which we've already discussed. So looking at diversification a little bit further by sector, you can see the chart on the right shows the spread of properties across the UK, and the larger the dot, the more income is generated in that particular location. You will see the strong weighting towards industrial and logistics assets, 46% of the portfolio by value. We have a reasonable weighting to retail warehousing. And retail warehousing is the side of the retail market that we think will be most robust. But it takes a little bit more explanation than just saying it. Retail has, over the last few years, demonstrated that it is polarizing into two principal camps, either destination retail or convenience retail. And my expectation is that post-COVID-19, when we all get up and back out and the non-essential shops open on the 15th of June, so we'll see what happens then, it will be that convenience sector, the retail warehouse parks that you can drive to, park for free, click and collect, deal with returns simply. It is that sector that will do well. And some of the key city centre locations where there are clearly just, the demographics dictate that you've got high population numbers in close proximity, that will also do well. And it's the bits in between, the mid-market towns, towns where you have to drive in to pay to park, but then a fairly uninspiring lineup of tenants that will struggle. What we might see in retail markets in the high street, because rents have fallen, and while falling rents is clearly not a good news story, because rents have fallen, it will perhaps pave way for independent retailers to return to our high streets. For far too long, through successive consumer booms, all of our high streets have become identikit high streets, dominated by chain retailers who've driven up rents, pushed out the independent retailers, and now have the cheek to say it's all the landlord's fault for charging them too much rent. They are victims of their own downfall, and sadly we've all been caught up in that. But I think we will see certain towns start to see a bloom of new independent retailers filling some of the void that is currently just being dominated by estate agents and charity shops. So perhaps there's some hope on the high street. But that retail warehousing is the bit we focus on, particularly where rents are low. You may, if you closely follow the property press, see negative comment about retail warehousing. That is often talking about the big out-of-town parks that are dominated by fashion retailers, where rents have risen and risen over the years, such that they're now comfortably ahead of £30 a square foot. Our retail warehouse portfolio has an average rent roll of only £14.70 per square foot. So a very different flavour of retail warehousing. And typically our occupiers are homewares, DIY, and the value retailers. And they are not competing. They're not being outcompeted by the internet. They remain physical stores, and we expect that to continue. And it's worth just touching on offices as well. There's an awful lot that's been said about offices. Here we all are working from home, and Many have perhaps posed the question, do we need offices? Do we need to go back to an office-based way of working? I think there are a number of schools of thought. An awful lot of people who are just longing to get back to an office and break the monotony of working from home. Someone, I think very sagely, said to me the other day, you know, it's okay saying we can all work from home when we're all doing it. But picture a scene where you have two businesses, one with 50 staff who all work remotely and another with 50 staff who have an office. I think it's reasonably clear that the business with the 50 staff who are working together collaboratively, sharing ideas, sharing thoughts in the same space, will have a competitive advantage. And I don't think that is going to be lost on businesses when it becomes possible to reoccupy offices. I think what we will see, though, is a continuation of the trends that, let's face it, started 20 years ago. 20 years ago, it was my experience working in an office that we started to see breakout areas. We started to see more than just a tea point in the corner. We saw kitchens, soft seating, the end of cellular offices, lots of open plan, collaborative working spaces. And that's a trend that has accelerated, particularly as technology has enabled it. And increasingly, we've seen people working from home prior to lockdown. And I think what lockdown has done, quite interestingly, has taken away the stigma of working from home. We all know that if we say we're working from home, that there's at least a handful of our colleagues who think we're lying in the sun in the garden. And I think what lockdown has demonstrated, it's certainly been my experience, that you can work very effectively and extremely hard from home. And we at Custodian have certainly been working hard, collecting rent and using video conferencing in a way that we simply didn't before, and really felt the benefits of that. So I think there will be changes in the way we work, but offices will still remain an important and investable asset for us. In fact, we had 2 office buildings under offer when we went into lockdown. Sadly, we had to step away from those acquisitions because we felt more important to protect cash than complete on those acquisitions. But we do see opportunities there. But location will become absolutely key. Increasingly, I think that office users will ask themselves the question, not so much, where do I need to locate my office because I need to be next to all my competitors, or I need to be in the heart of the city. They will instead say, where do I want to locate my offices based on where do my staff want to live? Because we don't need to be in each other's pockets, business to business, because we can connect as we're connecting now. And our staff might work from home. So locations like Oxford, Cambridge, Bristol, Bath, in the northwest, Chester, in the northeast, York, these are locations where staff will want to live and will now know, as a result of our recent experience, that they can work effectively, but they will still need offices for that collaborative space as well. So why small lot sizes? Any of you who've listened to me before have heard me talk about this, so I will skip through it, trying to pick up the key points as we go. Why does Custodian focus on smaller lot sizes? And I suppose this chart answers the question, so I'll explain it. The top line represents the 2-year rolling average of all property transactions under 10 million, and that's showing their net initial yield. And the light blue line shows all properties over 10 million. This is whole market data. It's collected by property data and analysed for us by Lambert Smith Hampton. And what you can see is that there is a clear margin for buying smaller lot size property. But perhaps more interestingly, what you can see is that that margin was a pretty consistent 70 basis points from 2000 all the way through till 2009 and a half, 2010. And then we started to see a divergence. So the question that throws up is, Was that divergence because of risk? Did larger lot size become lower risk and smaller lot size become higher risk? I would argue no. So if we accept that the previous 10 years set the risk premium, so let's accept, and I would, we could have a debate about that, but let's accept there is a risk premium for owning smaller properties of 70 basis points. How come the margin now and for the last 10 years has been 130 basis points or more? If the risk premium is only 70, it suggests to me we're getting 60 basis points of margin for taking no additional risk. Because what we're actually seeing is not differential in risk, but differential in the supply and demand dynamics. There are more people chasing larger lot sizes that are in limited supply, and fewer people who can be bothered, to be quite frank, can be bothered to own and manage the smaller properties. And you will hear people saying things like, we don't get enough bang for our buck with smaller properties. I take a different view. My view is it's not my money, and if we have to work a little bit harder to drive the returns out of those smaller properties, but we can have a higher running return, which means a higher income return, and we know that income delivers most of the return for commercial property, 70+% of the total return comes from income, then we think that that is extra work that's worth doing. I mentioned residual value a little bit earlier. And what's the importance of that? This is my noddy guide to property valuation. What makes up the value of property? Well, you've got the land that the building sits on, and that should appreciate in value over time. You've got the value of the building that's built on the land, and that will depreciate or obsolesce over time, but you can stave off that obsolescence through refurbishment and ultimately redevelopment, but let's keep it at refurbishment. You can refurbish your buildings, but the plant and machinery in those buildings tends to depreciate pretty quickly. And then you've got the lease, which is ultimately a wasting asset. The value of that lease falls to zero over the term of the lease. So if you've got a 5-year lease, it's going to decline over 5 years. But a 20-year lease, it's going to decline, obviously, over a much longer time period. But it is my sense that because of the short-term nature of human nature, people tend to overpay for long leases. And, excuse me, I wasn't expecting a telephone call. People tend to overpay for long leases. And we don't think that that is a sensible thing to do. We want our value to be in the bricks and mortar and the land. It's particularly notable with industrial buildings, where you have a large site area and a relatively inexpensive building compared to building an office building. Industrial buildings are relatively inexpensive. So you have more of your value in a relatively inexpensive and easy to refurbish building and the land. So what you don't then want to do is buy a 25-year lease where you've got all that value in the lease and every year the value of that lease is getting shorter. So that's what we mean by residual value. So it suits us to buy shorter leases, extend leases where we can, create some value. Refurbish buildings if we need to, that creates some value. And try and avoid obsolescence of both the building and depreciation of the lease term. So some recent examples of properties that we have acquired. Here is a property in Milton Keynes. It was let to Domino's Pizza, and they used to store their boxes and distribute their boxes from there. We acquired that. We took a surrender from Domino's Pizza. They wanted to leave. We spent £750,000 on the building, and it now looks like this. It's got a new yard, it's got new offices, it's got a new roof, and we really reset the clock on that building in terms of its use, and we relet that, as you can see, to ideal bathrooms, and we more than doubled the money we spent on it in terms of increasing the value, and we also made this attractive to a modern occupier. And then again in Warrington, this building acquired, let to DHL. It's right on the M62 in Warrington, and we took a surrender from DHL, got them out early. We used the money from that surrender and a little bit more besides to spend just over £1 million on completely refurbishing this building. Again, new roof, new offices, new doors, and that is fairly recently completed and is available to let. But even before it's let, we have more than recovered the money we spent on it, on refurbishing that building. And at the same time as refurbishing it, we enhanced the EPC, the Energy Performance Certificate, which is a key measure of sustainability for occupiers. And they rank from A down through the alphabet to G. But really, tenants will want them to be A, B, or C in the modern world. So we've taken this from an E to a B, so that suddenly it has become gone from being unattractive to being an attractive investment. And I think in the COVID-19 pandemic, the market has perhaps lost sight of some of the key drivers that were motivating us as landlords to buy and manage our portfolios. And ESG considerations were very key and remain important for us. And they're not just important because we are dyed-in-the-wool, sandal-wearing hippies. We think that there are very real financial benefits from having properties that meet the best standards of modern compliance with environmental, social, and governance issues. So when we get our properties back, as you've just seen, we will invest in them to bring them up to scratch. We've installed electric car charging points on our retail warehouse parks, working with a company called Instavolt. We're compliant with the legislation, as you might expect, but we've gone a little bit further, as indeed a number of our colleagues, a number of our peers have, signing up to the EPRA sustainability standards and the GRESB, Global Real Estate Sustainability Benchmark. And we think it's important to take a lead on this, but we think there are real financial benefits of doing it because our properties will be more attractive to occupiers, they will therefore let quicker, and I think we will start to see, which to date we haven't really seen across the market, we will start to see tenants differentiating by paying more rent for those buildings with lower EPCs and better ESG standards. And potentially in a post-COVID world, we're going to have to take a look at air conditioning systems in our buildings, making sure that we get sufficient air changes. We're going to have to look at densities of occupation and how that flows into sort of refurbishments we do as and when we get our office buildings back. So let's take a look forwards. What's the future for real estate investment post-COVID? I don't think we can ignore what I call the marginal argument. The margin of income return that property gives you over fixed income. So here it is against 10-year gilts, and you can see that all property, which is a sort of teal-coloured line, showing as wide a margin over 10-year gilts as it has for the last 10 years. And I don't think that argument can be ignored, particularly where the bank rate is at the moment. And we expect that to be a driver for continued investment in real estate post-COVID. And once people are reoccupying offices and the shops have opened, we think that that will still be important. And indeed, we think that people will still need real estate. And I've talked about how people might use offices, and I've talked a bit about retail and industrial logistics. And even, God willing, we will have pubs open again soon, and restaurants and hotels. But the scientists and the government have got a little bit to work out to make that possible for us all. But that will be good for real estate when it opens up. So to conclude, it's all about income. We like small lot sizes because of that additional marginal return, which helps us pay a high level of income. Diversification, we believe, reduces risk. Uncle Harry set the way that we have followed. The low obsolescence of industrial buildings, and something we try and look for with maybe shorter leases, low obsolescence in the leases too. We still think there is capacity for rental growth, in fact, in our small lot size industrial. Why is that? It's because there has just been an undersupply from development for a very long time now. All industrial development over the last few years has been focused on big box industrial, because that's where the demand has been, and it's been the quickest turnaround for the developers, as that has left a tight supply of smaller lot size, and we still think there's room for growth. And I'll finish by my favourite saying that income drives returns. So, any questions?
Well, thanks very much, Richard. I do have a few questions that have come through, yes. So let's kick off. To tie a couple of questions together, do you anticipate any fundamental shifts in your strategy as a result of COVID-19? And this sort of ties in with how it might affect any kind of trends that you see going forward in terms of both the risk and opportunity for Custodian. Who will be the best regional tenants in 5 years?
Yeah, so strategy, small lot size, we don't see a change there. Weighting to industrial and logistics, again, we'd tick that box and say more of the same. I think with offices, yes, a subtle change, focusing on those locations we liked. I mean, the opportunities we had under offer pre-lockdown were offices in Oxford and Manchester. Two towns that I would say would be winners in a post-lockdown world, but we might disinvest from locations that we think are not going to prevail in the post-lockdown, post-COVID world. I'm not going to call those out now, but it certainly makes us think about that office strategy a little bit more, because I think a little bit like retail, that office market is going to focus on either low-cost, convenient space, so large footprint business park type space, or very well located and high-spec offices where businesses have the opportunity to say a little bit about themselves, their culture, and have space for meetings, collaboration, and all that stuff we talked about. Retail has been challenging for some time, and we started to get out of secondary market high street retail some time ago, and we might see a little bit more of that. We did nail our colours to the mast of good value retail warehousing. The market has moved against us for 12 months, but I think we'll stick with that. I think that is still an opportunity there. If nothing else, you have a large site located in a semi-urban or suburban location, which would lend itself well to urban logistics and or redevelopment. But my expectation is we'll have demand from the retailers. So largely business as usual, but it's definitely informed our thinking.
And in terms of some of the alternative sort of other sectors?
Yes, well, I mean, there's an odd one. You know, for 5 years of 6 years of trading, we were fated for having a broad exposure to the alternative asset classes. and everyone was thinking in glowing terms about strategy, about sectors outside the principal office, industrial and retail. So we had leisure, car showroom, and what I mean by leisure, that's a horrible property vernacular. It could be bingo, cinema, bowling. The trouble with all of that in lockdown is it's all consumer-facing real estate. So that has been challenged, but we would hope in more normal times that will come back. And I think some of the alternative strategies will have had a more difficult time of late. I think of student accommodation. I know my eldest son has had a rebate from his student accommodation, from his university, for his student accommodation for this last term. And I think many others will feel the need to do the same. So that's been more difficult, but hopefully it'll come back.
Great. That's a question. So, how cautious or realistic do you think valuers were in their March NAVs? And have you seen any sort of further valuation marks since then? I suppose have the valuers got it wrong, or the stock market could be a question as well. The stock market trading, the general commercial property funds on fairly large discounts.
Well, I mean, the stock market are between 50 and 20% discount to NAV. I'm reasonably confident in saying the stock market has got it wrong. But I would be equally confident in saying the valuers got it wrong, because they almost always have, because you're trying to hit a moving target based on historic evidence. So it is, always with retrospect, you could say they got it wrong, but based on what they knew at the time, they made their very best effort, given that our valuation was the 31st of March and was lockdown, it was only 2 weeks prior to that. They made their very best effort to reflect the impact, particularly on our retail portfolio. I wouldn't be surprised, and I'm saying this without any foresight of what the valuers are going to tell me on the 30th of June, if property values came off a little more in June. But I'm not talking about 20 to 50% discounts to NAV. It might be a little bit more of the same. What we saw in March. I think it's a funny time to make a judgment when so many people are not using commercial real estate and or retail real estate, but they will be very soon, and we will judge it quite differently then.
And how are you seeing the transactional market currently? I know you sold some property last week, but if you are seeing transactions, who are the sellers? Are the open-ended funds active?
The open-ended funds, I think, are about to break cover, and what a rubbish time to be a forced seller. Then what a rubbish structure. Yeah. Sorry, that was an open goal, Justin. I'm sure one of the reasons there's been so much volatility in the publicly quoted property companies, property funds, is that the open-ended funds have been closed, blocked to redemptions. So all of the liquidity that was required by investors has had to come from the closed-end funds, the public companies, because the open-ended funds are locked up. When they break cover and need to sell, they're selling into a very difficult market. And I think it will suit them, as in the manager rather than the investors, to keep them locked up for a bit longer still. So transactions have been taking place, but at a much reduced rate. By and large, values have been holding, maybe give or take 5%, or more give than take. And as is so often the case in times of uncertainty, people will revert to what they deem to be lower risk deals. And very often that means long income. And you've already heard me talk about long income a little bit, but just by way of example, long leases to Travelodge. You know, everyone has been paying huge prices in the market for these, and there are some funds that own an awful lot of them. But Travelodge haven't paid the rent. It looks like they don't intend to pay the rent. And all of a sudden, that long lease has no value at all. And when you've paid over the odds for the benefit of that long secure income, to then lose that long lease or indeed the income, rather shoots a hole in that strategy. So I think while people will resort to long income in the hope that it sees them through the volatility, my advice would be to focus on good quality real estate to see yourself through that volatility.
And are you seeing any, besides the open-ended funds, is there, most of the listed market all seems in fairly good shape, if you're not at Amazon or an Into, is there much distress that you've heard about in the market?
No, there doesn't appear to be. I mean, the listed sector, of course, has gone into COVID lockdown with low gearing compared to going into the 2008 downturn, which of course was a banking crisis as well. So it was a fundamentally broken economy underneath. So it's gone in with low gearing. Banks are initially being supportive, although never quite as supportive as the government instructions would suggest they should be, but they are being supportive. And therefore we're not seeing that distress.
And then do you see, how do you see vacancies going over the next kind of 12 months? Do you see vacancies increasing in the market, or, and to the extent you can say, I suppose, in your portfolio, or do you just see rents rebasing to a level that allows occupancy to continue?
In more normal times, you would expect a shock to the economy like this to lead to increased vacancy. And while I'm not ruling out increased vacancy, our experience of the previous 12 months with retailers was that rather than increased vacancy, what we saw was an increase in CVA activity, which effectively rebased rents. And what the retailers were saying to us was, we want to trade from your store, we just don't want to pay the rent we agreed. So we are going to apply to the court to do it for a CVA and halve all our rents. You can probably tell by my tone, I took a rather dim view of that. So I suspect we might see more of the same, that rebasing of rents rather than vacancy. And probably for a landlord, rebasing of rents is less expensive than vacancy. Vacancy comes with the cost of empty rates. We still keep buildings insured, which is the cost of the landlord. You've got to pay an agent to find you a new tenant and get it relet. And then your incoming tenant would demand a period of rent-free as an incentive to take the lease. All that is cost to the landlord, and probably there's some refurbishment involved as well. So rebasing rents is often a vastly cheaper option than vacancy. And just answering the question specifically for Custodian, against a backdrop that is bound to see an increased vacancy across markets if we see an increase in unemployment and business failure, and it has to necessarily lead to an increase in vacancy. But our property management strategy is always to keep properties occupied, not quite at any cost, but certainly we won't cut off our nose to spite our face. So if we think it's in the best cash flow interests of the business to take a haircut on the rent rather than see vacancy, that's what we will do. Why is that important? It's because even with a haircut on the rent, that's what supports the dividend, and that is our principal objective.
Great. And another question here. I haven't read this article, but apparently the weekend, the Sunday Telegraph flagged that ministers were looking at a new code of conduct between commercial landlords and tenants. It noted that talks are underway to develop rules to help tackle the backlog of disputes that are built up. And I wondered if you had any comments on this, if you've seen it.
Well, it always slightly makes my shoulders drop when I read articles like that. There seems to be a fashion of late for labelling all landlords as greedy, avaricious bad guys, and all tenants as poor, beleaguered, put upon tenants. But let's just take retailers. Mike Ashley, Philip Green, they're not poor or beleaguered. They've made an absolute fortune out of retail, and they're now crying foul, saying it's unfair that the landlords are charging them too much rent. The only losers in that whole game have been landlords. Retailers have done very nicely out of it. But unfortunately, they seem to capture public sympathy more than landlords, whereas landlords are often not owners of super yachts. And in our case, the landlord of Custodian REIT is its shareholders, and the shareholders are made up of you, me, pensioners, ISA investors, and all those who are listening to this call's clients. So I find it a bit depressing, and I hope the government have more sense than to try and lay the blame or even the resolution entirely at the landlord's door. The tenants need to take responsibility for their own businesses.
And just a quick question on the covenants. Obviously, you mentioned that you'd been able to waive the interest cover covenants with the bank. Were the LTV covenants waived as well, or was there not deemed necessary?
No, they weren't, and that's for one of two reasons. We have a large amount. I should of course know the number, shouldn't I? Of uncharged property that we can charge to the bank if we need to fix an LTV breach should we hit one. We're at 22% LTV now. 35% LTV would breach the loan covenant, but we've got the best part of 70 to 100 million, and forgive me for not knowing the exact number, of assets that are currently uncharged that we could charge to cure any LTV breach. And indeed, the loan is drawn up in such a way as to envisage that should there be a breach, so there was no need to adjust that LTV covenant.
Okay. And then the question asking, how have you seen May rent collection so far? To the extent you're able to answer that, might be.
Well, wouldn't that be nice to talk about? Unfortunately, we haven't announced it, so I can't really talk about it. But I think we're on track to hit the sort of level of collection that we announced, which was 74% for the quarter. And happy certainly to share that on the basis that if it were different to what we'd already announced, we would have announced it to let shareholders know.
Okay. And if you had a blank sheet of paper now, what would be the major changes you'd make?
Crikey.
Absolutely.
That is a tough question to answer. On the one hand, it would perhaps be easy to say we would have exclusively an industrial portfolio. But actually, I don't think that's the answer. You know, I remember well enough, as little as, well, are we now 2020? As little as 6-7 years ago, if a developer built a big box industrial unit, they could expect 2 to 3 years vacancy before they got it let, because we were still suffering from an oversupply of industrial units that had been built through the early and mid 2000s. So I think I'd still have a diversified portfolio. As I said earlier, we'd started to reduce our high street exposure. I'd probably be happy to have little or no high street exposure, I do still believe in retail warehousing, so we'd certainly have some of that. And it would have been nicer to go into lockdown with less exposure to the consumer-facing alternatives, the likes of car showrooms, restaurants, hotels, pubs. But I think they've all got a place once we return to normality. So in answer to the question, still diversified, less high street, maybe a little bit more office exposure in the right locations, but we were trying to sort that out anyway. And while it feels the wrong answer in the current climate, I wouldn't want to have a single asset class portfolio, because I think that would lead to greater volatility over the long run.
And do you see Custodian, when do you see Custodian coming back into the market to buy again? Are you seeing compelling opportunities or anything like the Menzies deal last year?
The answer is exactly that. Compelling opportunities will bring us back into the market. It's something we are looking at all the time. We have undrawn debt facilities, and some of that could be drawn to increase the rental income of the fund. But we don't want to jump before we think pricing has adjusted, and there hasn't been enough transactions in the market to really demonstrate that that prices have adjusted. So it's looking for that compelling opportunity. And last year, we weren't wildly different. We did one deal last year, and that was the Menzies distribution portfolio, 26 million. But we felt it was compelling, and we think it'll serve us well for the long run. So that's what will bring us back in. And we've got cash and undrawn debt facilities to do that when the time is right.
Great. Well, I think that's probably a good note to finish on. We seem to have, I think, answered all the questions over the course of this call. So I will say thank you, Richard. Very interesting, and thanks to everyone that dialed in. Any further questions or comments, just please feel free to drop us an email, and I'm sure Rich will be happy to answer any follow-up questions any investors would have. Yeah. So I'll end the call now. Thank you very much.
Thanks very much, everyone.